Paula, and good morning, everybody. You may, like me, be in lockdown at the moment. I've done a quick Google search of lockdown, and apparently it is the confinement of prisoners to their cells for all or most of their day. I very much hope that you won't feel like a prisoner during today's presentation. There's 25 minutes, 15 minutes, I've got a few slides to give my thoughts and views, with 10 minutes for Q&A. So here we go. Let me share my screen and get the slides up and running. As I say, Mortgage Solutions gave me quite a brief, and I've only got 15 minutes to get through quite a lot. So I may not get through everything. These are my thoughts and my views. If you do have anything I haven't covered, please do join in the Q&A at the end to make it as interesting as possible. So as ever, I've got to look at the impact of the market with this year's events in mind, and it's best to do that with some numbers, isn't it? So great place to start. So these are some numbers via L&G's Mortgage Club, and you can very much see the pattern emerging. The faded large blocks behind are last year. The black line is our plan, but the thinner bars are what's happened this year. And you can see January, February, March, things were going really well, ahead of plan. I was quite pleased. But you then saw things drop away quite quickly as we went into lockdown and lending start to really dry up. And the blue bar and the red bar is retentions, which what we call retention, so that's product transfers. So you can see how big a part of the market they played then. But over the last few weeks and months, you can see lending volumes absolutely returning to the full. We have 11 out of the last 15 weeks of seeing volumes above last year. And as you can see, October was a new record for Club. We needed £7.7 billion worth of lending. So it gives you an idea of the pattern of lending and how busy it is at the moment. Don't just take our word for it. These are some numbers from our friends at 27 Tech, just really to show you the shape. Again, a strong start to the year, followed by a dip, followed by numbers now that are well above even the start of the year. So it's busy, isn't it? This is another slide. Again, you start to see the shape. This one starts in March, but you've got the initial dip followed by strong results at the end. This is our payments in advance. So for those of you who are used to using the club, you can know that you can claim your proc fee any time from exchange onwards. So we get quite a unique view into the market. It's not an app view, it's not a completion view, it's that view on exchange. And you can start to see that the volume of sort of my overdraft in effect is reaching pretty near record levels now, which is interesting. Another thing that the graph doesn't show is that we're starting to see the time between exchange and completion, i.e. when you guys as advisors are claiming to when lenders are paying us. That's starting to get bigger, starting to increase. So it's giving you a sign as well that things are probably starting to put a strain now in terms of the market as a whole. Perhaps great for you guys using that, you claiming your proc fee early. For me, it's more of a risk, and I watch that metric very carefully, as you can imagine. But again, something else that tells you the shape of the market. Another interesting thing that happened this year was product transfers. So you can see from this graph, the red line is, we call it retention, but these are how product transfers have happened this year. Green line was the plan, the blue line was what happened last year. As you can see, who went into lockdown, probably the only viable way of pushing business through was via product transfer. And you saw lending sort of approaching nearly half of all lending in sort of April, May time was by product transfer. And what's interesting though now is, even though it's really, really busy at the moment, we're still seeing the product transfers above where they were last year, which is surprising. However, maybe it's not that surprising when those people that are in perhaps financial difficulty, maybe that's their only option for getting mortgages at the moment. But it's quite an interesting picture, I think. Finally, our other friends at Mortgage Brain, this is from their data insights. This is about the availability of products. So you can see sort of at the beginning of March, nearly 15,000 products to just over 8,000 now. So at a time when demand has massively increased, we've seen the number of products available and the availability of products, especially in specific areas like high LTV there, come down. So that's quite interesting. and it's a mortgage and protection event. So what's happening with protection? It's interesting. Some insights from L&G. One is sales remain really, really strong. We're having a good year in terms of new business. Maybe that's because consumers are perhaps more aware of their mortality or the need for protection or income protection particularly. We have seen quite a wide variation in performance though. We've seen some firms who were really selling well, penetrating protection during lockdown. Many firms have actually continued that, which is fantastic. But as I say, there is a wide variation. Others have seen sort of protection sales and their penetration to mortgages fall off somewhat, which again is interesting. I think there couldn't be a better time for you guys to be discussing protection. It seems to me that consumers want it, and there's some stats there on the slide, but also consumers are finding it for themselves. One of the interesting things that we've seen is the rise in share of non-advised call centres selling protection. We are seeing more and more business through the non-advised route. So maybe consumers who maybe not getting the sale, maybe during their mortgage journey, they are going and finding those protection policies elsewhere. So I would just urge you, most of you have got mortgage and protection as your regulated title. So make sure that you are putting protection right at the top of your mind when it comes to conversations. So that's some numbers. Hopefully that's giving you a shape of the market and the impact that the pandemic's had. The next thing I was asked to do was to talk about the changing role of the advisor. I thought, how do I do that? So I thought, well, what's dominated my conversations? I meet with many advisors virtually now, most weeks, and many lenders as well. So, cover a broad range of topics. But these are the things that keep coming up. So I don't think any of these will be a massive surprise, but let's just quickly go through them. Lender service levels. Any lenders listening, please continue to make improvements to your service levels. We know demand's strong. We know, obviously, working from home and various factors that you're dealing with, but those service levels and meeting the demand that's coming through at the moment is absolutely paramount. So please help us. Lack of high LTV lending. Again, I'm not saying anything that you're not aware of. Getting LTVs more than 85% now is difficult. It's great to see some lenders dipping in and dipping out, coming in and making sure that they don't write too much business, that then they can swallow what they do right is great. And I do remain hopeful. Conversations with some of the larger lenders, I'm hoping now that it's more of a when, not if, we'll start to see lenders come back at 90% on a more full-time basis. And we really do need that. So again, lenders, please keep working hard and come back to this part of the market, not just for advisors, but for consumers as well. There's a big part of the market that's underserved at the moment. I'm talking a lot about stamp duty and a lot about Help to Buy, especially the cliff edges. I mean, Help to Buy is interesting. It's going to be hard to wean ourselves off that. I'm not necessarily getting the sense that, well, as of I'm speaking today, who knows what the government can announce, but I'm not getting the sense that there is a lot of appetite to extend Help to Buy, which is interesting. So we're going to have to deal with the changes to the schemes that are coming in. But also stamp duty. Maybe the stamp duty holiday came at a point when probably we may not have needed it because volumes were rising anyway. And maybe we will need it when it perhaps is going to be looked to disappearing in March next year. We are lobbying hard, as are many people across the industry, into HM Treasury and the government to try and try and convince them of the need to extend this. We think that's something that would be valuable, and we'll keep plugging away at that. But we do have to be aware of the 31st of March. We do have to understand that with all the service level delays at the moment, we put some research out there recently that perhaps if you haven't started your journey, your house moving journey or your purchase journey by the beginning of November, you are now starting to run a risk that you may not complete in time in order to take advantage of the stamp duty holiday. So it's going to be tough, and we need to keep lobbying on that. Also, we're busy. We're busy. I'm not sure what else I can say on that, but that tends to be the conversation that's coming through. I don't think many advisors have got anyone left on furlough now that I'm speaking to. In fact, recruitment, many are in a recruitment drive trying to get new advice on board, which is a fantastic place for our industry when you look at the broader economy as a whole. Also talking about us, what will our world look like moving forward, and people. I suppose some of my lockdown learnings have been the need to look out for each other. Please do. It's interesting. I think people go through ups and downs. I know I have my times when I'm flying. Other times I'm thinking, well, it's not so great. So do look out for each other and look out for your teams as well. And look out for yourself. We've proved that we can work from home though. May not be full time, but we can do it. We've got more trust in new tech. It's great to see the kids FaceTiming their grandparents and teaching them how to do various bits and pieces on WhatsApp. But from an advice perspective, more people trust Zoom and Teams now. So is that a future model for your businesses? 9 to 5 is less relevant. And also lots of conversations, specifically with the lenders around BDMs. Do you as advisors want BDMs coming around your offices? How do you want to engage with them? How will you want to interact going forward? And is that going to change? That's very much a lot of the lenders are asking, and I think that's a topic that will continue for some time. And please be vocal. I think we need BDMs. We need them now more than ever, and we need to see how that role evolves and making sure that they're delivering what we need. And finally, advice is more important than ever. I mean, without doubt, I think people's financial situations have become more complex, so they're going to need advice. And I think doing the right thing as an advisor is key now. I think we have to worry about the rise of CMCs, legal companies that may want to move on from payment protection, PPI, and find other areas to investigate and fight for consumers on. Is that going to be advice? Do the right thing, have a process and document it correctly. And I think we'll be fine as a community. So we need to be flexible. And as I say, please look out for each other. And then finally, an outlook for 2021 and beyond. Well, thanks, Mortgage Solutions, for that one. I'm not sure I've got a crystal ball or whether I can predict the market, but what I have done is I've reached out anyway. So I've reached out to some of the lenders, and particularly for an outlook on gross lending. How are some of the larger lenders thinking that the world is going to go? So you can see a graph there of 6 of the top 10 lenders that have been able to share what their views are in terms of where lending will finish this year. Lender A is actually a range between 200 and 220. So I'll put them at 210 because I couldn't work out the Excel to show that more adventurously. But I'm probably seeing a consensus, looking at those numbers. I think we'll end the year 220 to 230. I'm perhaps a little bit more optimistic that we might get towards 230. But it's going to be interesting considering 2019 ended at 266 billion. So we are going to see the market shrink this year, and absolutely, even though we're seeing record volumes at the moment, I don't think they're going to make up for what we missed out during late spring, etc. But as you can see on the slide, there is some better news. When I'm speaking to a lot of lenders, they are indicating that I think the advised intermediaries, our share of business will actually hold up quite well. They are seeing an awful lot of business not coming through branches, which for obvious reasons, and through the direct channels. So better news for advisors. We may not feel the full impact of that lowering of lending, but all the same, it looks like we're in for a smaller year. And importantly, most lenders I'm speaking to are predicting that 2021 will be sort of a similar ilk. So, gone are the days of 266 billion. We're now more like 220, 230 maybe. And in terms of other predictions, I'm sorry, I think it's quite foolish to predict what's going to happen. So I'm just going to give you a view of the drivers. So what are the reasons to be upbeat, and then what are some of the headwinds we're facing? And for me, I think the consumer demand that we're seeing at the moment is fantastic. It's unprecedented. I'm not sure we should keep using that word, but it absolutely sums up where we are. Consumer demand remains strong, and I think we're benefiting from a housing market where COVID is impacting people differently. I think we may be in the same storm, but not everybody's in the same boat. So people who may be suffering more financially, maybe younger ages, maybe they're not homeowners. So actually, the home buying market and the mortgage market seems to be a little bit immune from what's happened at the moment. We talked about stamp duty, but that's great and continues up until the end of March. We're in a low interest rate environment. This is different from previous crashes. We're seeing a lot of help from the Bank of Mum and Dad, seeing an awful amount of first-time buyers still coming to market even with 85% deposits. So they're finding that extra from their 95 and 90% LTVs, that they're finding from somewhere. And I think mortgage regulation has worked over the last few years. I don't think we're in the same situation that we have been in the past, where we were seeing 125% mortgages and self-cert mortgages, etc. We're not in that place now. So I genuinely think there's some reasons to be upbeat. However, the worst may be yet to come. We do have the cliff edges. We do have large chains. It only takes one person in that chain for their economic circumstances to change. And we could start to see chains falling apart, and if that happens in March, that could be quite tricky around stamp duty, etc. We have seen recent house prices go up, some indices 5-7%. When they go up that quickly, they could come down that quickly as well. And I think that's what some of the lenders are worried about. And I think we won't see them pushing back to certainly 95% LTV for a while until we see those house prices, etc., settle. Mortgage availability, we've discussed, it still remains constrained, especially for high LTVs, and we have lender and service capacity issues. So there's lots to be upbeat about, but certainly there's a whole host of potential economic uncertainty out there that could hit our market. But I try to remain positive. The market has defied gravity and defied all expectations so far, and why would it not continue to do that? So I'm going to remain positive anyway. So to summarize, I think the future will be what it will be. It's only a moment in time. When we look back with history, things will get better. This is a moment in time, and let's not forget that. Please focus on yourself and get match fit for the future. One of the big things at the moment is client retention is 65% of the market. So that's remortgages and product transfers. If your business is solely focused on the 35% of new business, what happens if that does start to diminish? Take some time to work on your business, not just in your business, even though it's really busy at the moment. Make sure you've got strong foundations and you've got a really solid direction for your business. I think advice has never been more important than it is now. But just be careful. I think regulation is only going to continue to transfer more responsibilities to you. So again, make sure you're all over your process and you're documenting it effectively. And finally, put the customer at the heart of your business. Be bold in your professionalism and do justify your fees and justify your worth. I think it's a great time to be an advisor. And I'm, for one, I'm going to remain upbeat. Thank you very much. I'll now hand over for questions. Thank you very much.